Most people have a savings account they feel pretty okay about, and an investing account they keep meaning to set up properly but haven't quite gotten around to yet. And every month, the savings account gets a little bigger, and every month, the investing account sits there like an unread email with a subject line you know is important but keeps scrolling past. And I find this genuinely fascinating. My name is Threk, and I spend way too much time thinking about money, how people relate to it, and why the choices that feel responsible and safe are sometimes the ones quietly costing us the most in the long run. Because that's the thing about saving versus investing that most people don't fully sit with. They look almost identical from the outside. You move money somewhere, you feel responsible, you move on with your day. But underneath the surface, something very different is happening to those two piles of money, and by the end of this, I think the difference is going to feel a lot more personal than it probably does right now. So let's start with the obvious question. How is $50 a week investing better than $500 a month saving? Mathematically, $50 a week is about $200 a month, so you'd be putting away less than half what the saver is putting away. And yet, over long enough time horizons, that $50 a week invested will often end up significantly ahead. Not because investing is magic, not because the universe rewards impatience, but because of two things working together: compounding and frequency. Let's talk about compounding first, because it gets mentioned constantly but rarely explained in a way that actually lands emotionally. Compounding is basically what happens when your returns start generating their own returns. Your $50 earns a little, then that little earns a little, then that slightly bigger pile earns even more. It's slow at first, almost insultingly slow, like a snowball rolling down a very gentle hill, but given enough years and enough consistency, it becomes something almost structurally powerful. The key word there is years, which is why frequency matters so much. When you invest weekly instead of monthly, you're not just putting in more often, you're giving your money more individual starting points, more early entry opportunities, more moments for compounding to begin on each new contribution. You're essentially planting seeds more consistently instead of waiting to plant them all at once. Now here's where the $500 a month saver runs into a problem they didn't see coming. Saving money in a regular bank account or even a high-yield savings account feels like progress, and it is progress of a certain kind. You're building a balance, you're being responsible, but most savings accounts are not growing your money in any meaningful compounding sense. They're storing it, and storage is expensive over time, not in fees, but in opportunity. Every year your $500 sits in a savings account earning 1 or 2%, it's falling behind inflation in real terms. The number goes up, but the purchasing power of that number often barely keeps pace or quietly loses ground. You're protecting the dollar amount while the actual value erodes. Investing that $50 a week into a diversified index fund, on the other hand, puts your money inside the actual engine of wealth building. Markets fluctuate, obviously. Some years are rough and some are great, and none of them are predictable. But over 20 or 30 years, the historical average returns on diversified long-term investing dramatically outpace what a savings account can offer. The person investing $50 a week is not just saving less and winning more, they're playing a fundamentally different game. There's also a behavioral element here that I think is underrated. Investing $50 a week is sustainable for almost everyone at almost every income level. It doesn't require waiting until you have enough to make it worth it. It doesn't require a big month or a bonus or a moment of discipline you've been building up to. It's small enough to start immediately and consistent enough to build momentum. The $500 a month saver, on the other hand, is at constant risk of the month just not having $500 left in it. The plan is bigger and therefore more fragile, and fragile plans get interrupted, postponed, and quietly abandoned in ways that small, consistent habits rarely do. $50 a week is the kind of commitment your budget barely notices, but your future notices enormously. So if you're sitting on a savings account wondering why it doesn't feel like enough, and you keep pushing the investing conversation to some future version of yourself who has more money and more confidence and more time to figure it out, I want to gently suggest that version of yourself isn't coming. The best investor isn't the one waiting to invest big, it's the one who started small, started consistently, and let time do the heavy lifting your savings account was never designed to do. Start with $50. Start this week. Not because it will make you rich overnight, but because it plants something real, something that compounds, something that doesn't just store your effort, but multiplies it. And 10 years from now, that decision to start small and stay consistent will look like one of the smartest financial choices you ever made.